Financial ratios are essential tools used by business owners, investors, and analysts to evaluate the financial health and performance of a company. These ratios provide a snapshot of a company's profitability, efficiency, liquidity, and overall financial stability. They help stakeholders make informed decisions regarding investments, creditworthiness, and strategic planning. Understanding and applying the right financial ratios can lead to better business management and clearer insights into a company's financial position. In this video, we'll explore the top 10 most used financial ratios in business analysis, explaining their significance and how they can be used to assess a company's performance. 1. Current ratio. The current ratio is a liquidity ratio that measures a company's ability to pay its short-term liabilities with its short-term assets. It is calculated by dividing current assets by current liabilities. A ratio above 1 indicates that a company can cover its short-term obligations, while a ratio below 1 suggests potential liquidity issues. Formula: current ratio equals current assets divided by current liabilities. Why it matters. A healthy current ratio, typically between 1.5 and 3, indicates that a business is in a good position to handle short-term financial obligations, reducing the risk of insolvency. 2. Quick ratio, acid test ratio. The quick ratio is a more stringent version of the current ratio. It excludes inventory from current assets, as inventory may not be as easily converted to cash in the short term. This ratio provides a clearer picture of a company's immediate liquidity. Formula: quick ratio equals current assets, inventory, divided by current liabilities. Why it matters. A quick ratio greater than 1 is considered good, as it suggests that a company can cover its current liabilities without relying on the sale of inventory, which may not be easily liquidated. 3. Debt-to-equity ratio. The debt-to-equity (DE) ratio measures the financial leverage of a company by comparing its total liabilities to its shareholders' equity. A higher DE ratio indicates that a company is using more debt to finance its operations, which can increase risk but may also lead to higher returns. Formula: debt-to-equity ratio equals total liabilities divided by shareholders' equity. Why it matters. A high DE ratio could suggest that a company is heavily reliant on debt, which may pose a risk during economic downturns or periods of low profitability. On the other hand, a low ratio indicates a more conservative financial structure. 4. Return on assets, ROA. ROA measures a company's ability to generate profit from its assets. It shows how effectively a company uses its assets to produce earnings. A higher ROA indicates more efficient use of assets. Formula: ROA equals net income divided by average total assets. Why it matters. ROA is important for evaluating how well a company is using its assets to generate profit. Businesses with high ROA are generally more efficient and productive. 5. Return on equity, ROE. ROE indicates how much profit a company generates with the money shareholders have invested. It is a measure of the profitability relative to shareholders' equity. Formula: ROE equals net income divided by shareholders' equity. Why it matters. ROE is one of the most important profitability ratios. A high ROE suggests that the company is generating substantial profit from shareholders' equity, which is attractive to investors. 6. Gross profit margin. Gross profit margin measures the percentage of revenue that exceeds the cost of goods sold, COGS. It shows how efficiently a company is producing and selling its goods. Formula: gross profit margin equals revenue, cost of goods sold, divided by revenue times 100. Why it matters. A higher gross profit margin means that the company retains more revenue from each sale to cover other operating expenses. It is a key indicator of pricing strategy and production efficiency. 7. Operating profit margin. Operating profit margin measures the proportion of revenue left over after paying for variable costs associated with production. It is a key indicator of operational efficiency and profitability. Formula: operating profit margin equals operating income divided by revenue times 100. Why it matters. A higher operating profit margin means a company is better at converting revenue into profit before non-operating expenses and taxes are considered. It indicates good management of operational costs. 8. Net profit margin. Net profit margin shows the percentage of profit a company makes from its total revenue, after all expenses, including operating costs, taxes, and interest, are subtracted. It is one of the most important profitability ratios. Formula: net profit margin equals net income divided by revenue times 100. Why it matters. This ratio provides a clear picture of a company's overall profitability. A higher net profit margin indicates that the company is efficient at converting revenue into actual profit. 9. Inventory turnover ratio. The inventory turnover ratio measures how often a company's inventory is sold and replaced over a period of time. A high inventory turnover rate indicates efficient inventory management, while a low rate suggests overstocking or weak sales. Formula: inventory turnover equals cost of goods sold divided by average inventory. Why it matters. A high inventory turnover ratio indicates that the company is effectively managing its inventory and sales. On the flip side, low turnover could signal poor sales or excessive inventory. 10. Accounts receivable turnover. Accounts receivable turnover measures how efficiently a company collects its receivables from customers. It shows the number of times a company collects its average accounts receivable balance in a year. Formula: accounts receivable turnover equals net credit sales divided by average accounts receivable. Why it matters. A higher accounts receivable turnover ratio indicates that a company is efficient in collecting payments, improving cash flow. A low ratio suggests that the company may be struggling with collections and could face cash flow issues. Financial ratios are indispensable tools for evaluating a company's financial performance and making informed business decisions. Whether you are an investor analyzing a company's profitability, a business owner looking to improve operations, or an accountant assessing a client's financial health, understanding and using these financial ratios is crucial. By regularly monitoring these ratios, you can ensure that your business remains financially sound and is positioned for growth and success.